If you've looked into futures trading, you've probably seen the word margin come up a lot. It's one of the most important concepts in futures and often one of the most misunderstood. In this video, we'll break down exactly what margin is, how it works, the different types you'll encounter, and what happens when your account gets close to your limit. Let's get into it. In futures trading, margin is a deposit that you put up to hold an open position. It's not a fee, you're not paying for the contract. You're just posting a good faith deposit to cover potential losses. Think of it like a security deposit on an apartment. You don't lose it automatically, it's just held while you're in the position. This is what makes futures different from buying a stock. With a stock, you pay the full price up front, but with a futures contract, you only need to put up a fraction of the contract's value. That's leverage, and margin is how it works. Keep in mind that leverage amplifies both gains and losses, so risk management is essential. There are a few types of margin you need to know about. The first is initial margin. This is the amount required to open a position. It's set by the exchange and it can change based on market volatility. The second is maintenance margin. This is the minimum your account balance must stay above while you're holding the position. It's usually lower than the initial requirement. Here's an example. Say the initial margin on a micro S&P 500 contract is $1,200. The maintenance margin might be set at $1,080. As long as your account stays above $1,080, your position will stay open. If it drops below that level, you'll receive a margin call. We'll cover that in a moment. Many brokers also offer intraday margin, sometimes called day trade margin. This is a reduced rate that applies only while the market is open and you're actively trading. Intraday rates can be significantly lower than the exchange set initial margin. For example, at MetroTrade, the intraday margin on the micro S&P 500 contract starts at only $50. That lower requirement gives traders with smaller accounts access to futures markets during the trading session. But it comes with a catch. If you're still holding that position when the market closes, your account needs to meet the full overnight margin requirement, or the position may be closed. One thing to keep in mind is that margin scales directly with the number of contracts that you hold. If the intraday margin on one MES contract is $50, holding 2 contracts requires $100. 5 contracts would require $250. The math is straightforward. This is why position sizing matters so much in futures. Adding contracts increases your exposure and your margin usage at the same rate. Before you scale up, make sure your account can support the additional requirement, with room to absorb normal price movement. A margin call happens when your account equity drops below the maintenance margin level. When that occurs, your broker will require you to deposit more funds or close some positions to bring your balance back up. In many cases, if the deficit isn't addressed quickly, your broker may liquidate your position automatically to prevent your account balance from going negative. How and when that happens varies by broker, so it's worth reviewing your broker's margin and liquidation policy before you start trading. The best way to avoid a margin call is to monitor your account balance regularly and never trade more contracts than your account can comfortably support. Margin is what makes futures trading accessible to smaller accounts, but it also means losses can add up quickly if you're not managing your size and account balance carefully. To learn more about how futures trading works or to open an account, visit metrotrade.com.